So if you look at the... Oh, wait. Are we actually recording right now?
Yeah, the light's on. We're rolling.
Okay, let's just jump right in. Welcome to episode 3 of the Joinprop podcast. I'm Ken Rolliger, head of content here.
Yeah.
And sitting across the table from me is my co-host.
Jessica LaRusso here. And honestly, I am already completely exhausted by this topic.
Right. Yeah, I get that.
Yeah.
Because we are looking at this. I mean, I brought this massive stack of research from the content team today.
Yeah.
And the subject is, look, it's controversial. There's really no other way to frame it.
It's highly radioactive, is what it is.
Yeah. We are doing a deep dive into the absolute explosion of proprietary trading firms over the last, 5 to 10 years. And specifically, we want to address the massive, very loud accusation that this entire industry, like the whole ecosystem, is just a giant predatory scam.
And I'll just say it right now. It is so hard not to look at it exactly like that right out of the gate. I mean, you sent me these sources last night. I'm reading through them on my couch, and my immediate visceral reaction is just, how is any of this legal? No, seriously, we are talking about an industry that has essentially gamified financial risk for regular people. If you're listening right now and you've spent, more than 5 minutes on finance, TikTok, or Instagram, you know exactly what I mean.
Oh, the lifestyle marketing.
Yeah.
The rented Lambos.
Exactly. It's every day, folks. Not like Wall Street insiders with finance degrees trying to get their hands on massive amounts of trading capital and the hoops they have to jump through. I mean, it's deeply uncomfortable to read about.
I get it, but okay, wait. We need to unpack this carefully. Because the truth, at least according to the actual data and the mechanics of the business, is a lot more nuanced than just pointing a finger and calling the whole thing a fraud.
Nuanced.
It is.
Yeah.
So the mission for today's deep dive is to literally tear apart the business model of these prop firms. We're going to look at the legit ones, the absolute sketchy scam artists, the brutal math behind how they actually make their money, and basically figure out if the people screaming scam are right, or if they just, and I know this sounds harsh, if they just don't understand how trading actually works.
I will tell you right now, my defenses are all the way up. I am firmly in the this feels incredibly shady camp. But fine, lay it out for me and for anyone listening who is just as confused. What is the basic blueprint here? What are these firms actually claiming to do?
Okay, so the core concept of proprietary prop trading is, traditionally, that a firm uses its own capital to trade the financial markets.
Right.
They aren't using client money like a traditional hedge fund would.
Okay, that makes sense.
That's the old school definition. But the modern prop firm model, the one that has completely exploded online and that you're seeing ads for everywhere, is different. These firms are essentially crowdsourcing trading talent.
Crowdsourcing.
Right. They tell regular people, hey, if you can prove to us that you know how to trade, we will give you access to our capital. And you get to keep 70 to 90% of the profits you make.
Okay, but the operative phrase there, the actual trapdoor, is if you can prove to us. That is the catch, right?
Yes.
Yeah.
Exactly. Because they don't just hand you $100 grand and say, go crazy, have fun.
Yeah.
You have to pass an evaluation phase. The industry usually calls it a challenge.
Yeah.
And to take this challenge, you have to pay an upfront fee.
Right.
Depending on how much capital you were trying to get funded with, that fee ranges anywhere from, $100 to well over $1,000.
Stop right there. I mean it. That feels like a scam.
It is not a scam.
I am not saying it's legally classified as a Ponzi scheme. I'm saying it feels like one. You are literally paying to get a job.
No, it's not a job.
If you're listening to this, think about your own career. In what other industry do you have to hand over $1,000 of your own money to your prospective employer just to prove you know how to do the work? It's completely backwards.
Look, you have to look at it from the firm's perspective. Okay, wait, let me back up. Let's just play this out logically. If a firm just gave $100,000 of real, actual capital to any random person with a Wi-Fi connection who claimed they could trade, that firm would be bankrupt by Tuesday. Right. It is corporate suicide. The fee acts as a risk filter. It ensures that the person taking the challenge actually has some skin in the game. They aren't just treating it like a video game where they can blow up an account and just hit restart.
But they're making money off the filter. That's the problem.
Yeah.
If I apply for a job at a tech company, right, they give me a coding test. They don't charge me $500 to take the coding test, even though it costs them human resources and server time to evaluate me.
A tech job isn't handing you 100 grand to day trade with.
The idea that you have to pay for the privilege of being tested is inherently predatory, because who does it target? It targets people who are desperate for capital. It targets people who don't have 100 grand of their own sitting in a bank account.
But it's not an employment contract. You aren't an employee. You are an independent contractor. You are essentially paying for access to their simulated infrastructure so you can prove your metrics.
Simulated, so it's not even real money during the test.
No, the evaluation is on a demo account, and the metrics are strict. Like, during this challenge, you have to hit a specific profit target. Usually it's around 8 to 12% over a 30 to 60-day period, while staying within strict drawdown limits.
Okay, wait, stop. Explain the drawdown thing, because the source material went really deep on that, and it got incredibly dense, and if I'm confused, the person listening in their car right now is definitely lost. Make sure we are actually clear on how people fail these things.
Right, so a drawdown is basically, okay, let's say you have a $10,000 account. Your max drawdown is 10%. That means if your account balance ever drops below $9,000, you fail.
Okay. So you lose $1,000, you're out. That's simple enough.
The computer cuts you off. You're out.
Yeah.
But there's also daily drawdowns and trailing drawdowns. Like, if your equity drops below a trailing watermark from your highest peak, you're out.
Wait, trailing watermark? No, you lost me. That sounds like casino jargon. That sounds like a rule designed in a boardroom to make sure the house always wins.
Okay, yeah, wait. Let me back up. Because you're right, trailing drawdowns trip everyone up. Let's walk through the math. Let's make it simpler. Imagine you start with $100,000.
Okay. 100 grand.
The rule says your account can never drop by more than 5% from its highest point. So initially, 5% of 100 grand is $5,000. Your failure point is 95,000.
Got it. So I can lose up to 5 grand.
Right. Now let's say you have a great week. You make $4,000 in profit. Your account balance is now $104,000.
Okay. So I have a ton of breathing room now. I can lose, what, 9 grand before I hit 95?
No. That is the trap of the trailing watermark. The watermark trails your highest balance. It moves up with you.
Wait, what?
So your new high is 104,000. Let's just keep the math simple and say it's a static $5,000 trail from your highest peak. Your new failure point isn't 95,000 anymore. It's $99,000.
Wait. Are you serious?
Yep.
So even though I haven't lost any of my initial 100 grand, even if my account drops to 99,500, which means I'm technically still down only from my profit, but I still have almost all my starting money, I fail.
Exactly. If at any moment, even if a trade is just open and fluctuating, what we call floating equity, your account hits that new trailing failure line, a computer algorithm instantly terminates your account. You fail the challenge, your fee is gone.
Which means they keep the money.
Yes. The firm keeps the evaluation fee. And if you want to try again, you have to pay another fee.
And there it is. I mean, come on. That is why people call it a scam. If you're listening to this and doing the math in your head, the incentive structure is entirely fundamentally warped.
How so?
If the firm makes money every single time someone hits an invisible moving tripwire and fails, why would they ever want anyone to actually pass?
Okay. Honestly, you are completely justified in being skeptical here.
Yeah.
Because, and the research our team dug up explicitly points this out, there's a whole subset of this industry that operates exactly the way you are fearing.
I knew it.
It's a known thing in the space. It's called the churn and burn model.
Churn and burn sounds lovely. Sounds like something you want your life savings tied up in.
It's brutal. I'm not going to defend it. The legitimate firms want you to pass so they can make a percentage of your trading profits in the real market. But the sketchy firms, the outright frauds, they look at the model and realize it is way, way more profitable to just collect evaluation fees and never actually pay anyone out.
Right. It's basically a toll booth to nowhere.
Exactly. So they create these perpetual revenue streams entirely off failed evaluation.
By rigging the rules.
Yes. They design the evaluation criteria to be nearly impossible. But they don't do it overtly. They don't put on their website, you need to make 1,000% return in 2 days. Nobody would buy that. They use hidden rules.
The high-impact news thing, I saw that in the notes. That is so insidious. Walk through how that actually works in practice, because that legitimately blew my mind when I read it.
Oh, this is the classic trap. So trading during major economic announcements, like the non-farm payrolls in the U.S., or when the Fed drops inflation data, is very volatile. Prices whip around violently.
Right, the market goes crazy.
Exactly. So a lot of prop firms have a rule in their terms of service saying no trading during high-impact news, which on the surface, if you don't know better, sounds like reasonable risk management. Right?
Sure. I mean, you don't want your traders gambling during a massive, unpredictable spike.
Right. But here is the trick, and this is where the churn and burn firms get you. They conveniently refuse to define what high impact actually means.
What do you mean they refuse to define it?
I mean, there's no master list provided to the trader beforehand. There's no calendar that says these 5 events are off limits. It's entirely subjective. So a trader is doing well. They're managing their risk. They're days away from passing the challenge. They take a trade on a random Tuesday morning during some obscure European central bank speech that barely even moves the market. And suddenly, they get an automated email. Account terminated. You traded during high-impact news.
That is just blatant theft. You are changing the rules of the game after the ball has already been thrown.
And it gets worse. Because of these engineered traps, the pass rates for some of these churn and burn firms are practically zero. The data from our research highlights this specific stat, and I really want the listener to hear this. Some of these sketchy firms have engineered their rules so aggressively that their pass rates are below 1%.
Wait, no, below 1%, less than 1 in 100.
Less than 1 in 100 people pass.
I need a second. Just let me process that. That is not an evaluation. That is a slaughterhouse. If a university had a 99-point-something% failure rate for its freshman class, the government would shut it down tomorrow. If a medical exam failed 99% of the people who take it, you'd assume the test was physically impossible. But here, it's just considered a valid business model.
It is a highly optimized fee harvesting machine. That's what it is. The entire architecture of the firm isn't built to facilitate trading. It's built to manufacture failure.
Yeah.
But they have to make it look close. They want desperate traders to feel like they almost had it.
Oh, I was so close. I just tripped the drawdown.
Exactly. Oh, I just tripped the trailing drawdown by $10. I'll get it next time. And then they rebuy the challenge. It's pure psychological manipulation.
And these people are losing hundreds, maybe thousands of dollars each time they rebuy. But wait, okay, what about the legitimate firms? Because you keep saying there is a difference. You keep defending this core model. If the scammers are failing 99% of people, what are the so-called good firms failing? 50%.
Okay, here is where it gets really uncomfortable, even for me. Let's break down the actual economics of a prop firm, the literal math of how they operate, using the industry standard numbers from the sources. If you're listening, actually try to picture this math. Let's run a scenario with 1,000 traders attempting a challenge.
1,000 traders. Okay, I'm tracking.
1,000 traders sign up. Let's say they take an average-sized challenge, paying a $500 evaluation fee.
So 1,000 times 500, that is $500,000 in upfront cash. Day one, just in fees.
Right. $500,000 sitting in the firm's bank account before a single real trade is ever placed. Now, out of those 1,000 traders, what do you think the industry average pass rate is for a legitimate, non-scam prop firm, the ones that don't use fake news rules?
I mean, if it's legit and the rules are actually fair and transparent, maybe 20, 30%.
4 to 8%.
Wait, what? 4 to 8?
The typical pass rate for initial evaluations across the entire industry, the good ones included, is 4 to 8%.
You have to be kidding me. That's terrible. How is that any better than the scammers?
Because the scammers are engineering failures through fake rules. The legitimate firms just have strict parameters, and the reality is, and nobody likes hearing this, most people simply do not know how to trade profitably while managing risks.
But still.
Profitable trading is insanely difficult. Most retail traders lose money. That's just a statistical fact. So let's use 5% for the math to keep it clean.
Fine. 5% of 1,000. That's 50 people. So out of 1,000 hopefuls, only 50 actually get funded. The other 950 just lost their $500 and went home.
Yes. So the firm has 50 funded traders now. Let's say each trader is managing a $100,000 account. And let's assume they are good. They actually survived the funded phase and generate a 5% return for the month.
Okay, 5% of $100,000 is $5,000. So 50 traders making $5,000 each.
Exactly. 50 times 5,000 is $250,000 in total trading profits generated by the funded traders in the real market. Now, we have to look at the profit split.
Right, the payout.
The industry standard is typically 70 to 90% in favor of the trader. Let's use an 80-20 split.
Okay, so the firm keeps 20% of the $250,000. That's $50,000. The firm makes 50 grand, and they pay out the remaining $200,000 to the 50 traders.
Correct. Now let's total up. I want you to look at the whole picture for the firm. In this month, they brought in $500,000 from the evaluation fees of the 1,000 people who tried. Plus, they made $50,000 from their share of the successful traders' profits.
So $550,000 total revenue.
And their expenses, their payouts to the successful traders, were $200,000. So they brought in $550,000, paid out $200,000, and netted $350,000.
Wait. I mean, look at those numbers. That is literally their business model.
What do you mean?
They made $50,000 from actual trading. They made $500,000 off the losers. They are making 10 times more money from people failing than they are from people succeeding.
Yes, that is the math.
How can you defend that? You just sat there and proved that the critics right. The evaluation fees completely dwarf the actual trading profits. If the vast majority of the revenue is coming from failed fees, then they aren't a trading firm. They are a fee collection agency masquerading as a trading firm.
It's not that simple. You are looking at the revenue split and immediately assuming malicious intent, but you have to look at the risk profile of what they're doing.
I am looking at $500,000 built on a graveyard of failed tests.
The math I just gave you is a sustainable model for giving retail traders capital. The firm needs that massive buffer from the evaluation fees because trading is inherently risky. Think about it. What happens if the market tanks and those 50 funded traders don't make 5%, but instead they all hit their 5% drawdown limit and lose money? The firm eats those losses in the real market.
But they are playing with house money at that point. They just collected $500,000 from the 950 people who failed. They can afford to eat a loss. It still feels entirely predatory. You have built an entire ecosystem that fundamentally relies on a 95% failure rate just to keep the lights on.
I push back on that hard. I really
Yeah.
do. Just because a business is highly profitable on the front end doesn't automatically make it a fraud, so long as they actually honor the contract and pay out the winners.
Honor the contract.
And that is the crucial distinction that the skeptics ignore. If you pass the test and you make the profit, and they wire you your 80% cut without any excuses, without any hidden rules, then the contract was honored. The fact that 950 other people weren't skilled enough to pass doesn't make the firm a scam. It just makes trading hard.
It makes the marketing of the firm disingenuous because they aren't marketing it as, come try the hardest test in finance. They aren't telling you you have a 95% chance of failing. They are marketing it on social media with Lamborghinis and Rolexes and guys working from laptops on a beach in Dubai, implying that anyone can do it. They are selling a dream to harvest that $500 fee.
Okay, I will concede. The marketing can be toxic. I'm not defending the guys on Instagram flashing rented cars. That stuff is garbage. But we have to separate the marketing noise from the actual mechanical operations of established firms.
Fine. Give me an example of an established firm.
The sources our team compiled specifically mention firms like FTMO, TopStep, E8 Funding. And they point out that for these legitimate operations, failed evaluation fees are just one component of how they survive. It's not their only lifeline. They aren't just vampires feeding on failed traders.
Okay, then enlighten me. Where else is this money coming from, if not the pockets of the people who failed?
They actually make significant money off the trading volume itself. This gets a little into the weeds of market mechanics, but think about how retail brokers work. When you place a trade, there is a transaction cost. Established prop firms do massive volume. We're talking thousands of traders executing tens of thousands of trades a day.
Right.
Because of that insane volume, they get massive discounts, what they call volume rebates, from the brokers they route their trades through.
Okay, so they are getting kickbacks from the brokerage side based on sheer quantity, like buying in bulk at Costco.
Right, exactly. And spread markups.
You're going to have to explain that one, because if I'm listening to this right now, I have no idea what a spread markup is.
Okay, think of the currency exchange counter at an airport. You know when you travel to Europe?
Yeah, and they totally rip you off on the exchange rate.
Right. The actual real-world exchange rate might be, say, $1 to €1.
Yeah.
But the counter at the airport sells you the euro for $1.10, and if you want to sell it back to them, they buy it for 90 cents. That difference, that gap between the buy and sell price is the spread. That's how the booth makes money.
Okay, I'm with you.
In electronic trading, the spread is tiny fractions of a cent. But prop firms can add a microscopic markup to the spread provided by their broker. Because they have thousands of traders executing millions of trades, those fractions of a cent compound into massive revenue. Every single time a trader clicks buy or sell, the firm makes a micropenny.
So they are monetizing the actual activity of trading, regardless of whether the trader wins or loses the trade.
Exactly. A funded trader could break even for the month, no profit, no loss. They just kind of treaded water. But because they took 100 trades, the trot firm still made money off the spread markups and the volume rebates. That is real, sustainable revenue that has nothing to do with people failing challenges.
All right, I hear the mechanics of it. I understand how a legitimate firm functions on paper. But practically speaking, if I am the listener right now, how on earth is someone with a few $100 and a dream supposed to tell the difference?
Well, you have to look for it.
If I am looking at two websites, and they both have slick graphics, and they both promise me a $100,000 account for a $500 fee, how do I know which one is the legit volume rebate firm and which one is the churn and burn scam with the fake news rules?
It all comes down to the red flags.
Yeah.
And the deep dive research outlines these beautifully. We need to go through them. The absolute biggest, most glaring, neon flashing red flag is the promised profit targets. If a firm is out there promising you 50% or more in monthly returns, run. Just run.
Because it's mathematically absurd.
It is laughable. I openly mock these numbers when I see them online. Think about it. The greatest hedge fund managers in the history of the world, the absolute titans of Wall Street with PhDs in astrophysics and supercomputers located right next to the exchange, they fight tooth and nail to make 20% a year. A year.
And these firms are promising double that in a month.
Right. If you could consistently make 50% a month in the financial markets, you wouldn't be paying a proc firm $500 for a challenge. You wouldn't need them. You would own the world in 3 years through compound interest.
So anything promising astronomical quick returns is just preying on financial illiteracy.
100%. It is a mathematical impossibility framed as a guarantee.
What else?
No verifiable track record. If the company was registered 3 weeks ago in some obscure offshore tax haven and they have no corporate history, no LinkedIn presence for their executives, that's a massive red flag.
Yeah. The source material mentioned unclear corporate structure. If you can't find out who the CEO is or where their headquarters are actually located, you shouldn't be sending them your credit card information.
Exactly. Another one is pressure tactics. Legit firms don't care when you take the challenge. The market isn't going anywhere. Scams will use countdown timers on their websites. You fail a challenge, and instantly you get an email. Your account failed. Rebuy the challenge in the next 10 minutes for a 20% discount.
Oh, that is so gross.
They are trying to catch people in a purely emotional revenge trading mindset. They know you're angry, you just lost, so they dangle a discount to get you to impulse buy another challenge while you're still tilted.
That goes right back to the casino analogy. When you lose at the blackjack table, the casino wants you to go straight to the ATM and pull out more cash while you are still emotional and chasing your losses. If a prop firm is operating like a casino pit boss, it's not a trading firm.
Right. And then there was the lack of transparency on execution. If they cannot explain exactly how your trades are routed or what their slippage rules are, they are hiding something. And finally, zero social proof. And I'm not talking about paid actors on YouTube saying, this firm changed my life. I'm talking about third-party, verified, independent communities.
Which brings up a really massive question that has been bothering me this whole time.
Okay, what is it?
If there are so many of these shady actors, these churn and burn operations, literally stealing millions of dollars through hidden rules and manufactured failures, where are the regulators? Why hasn't the SEC or the CFTC just completely cracked down on this uniformly?
And here we step into the grand regulatory gray area of the prop trading world. This is the crux of the whole debate.
I hate the term gray area. I really do. In my experience, gray area is just finance speak for, we found a massive loophole to avoid the SEC.
It is a loophole, but it's based on a fundamental legal distinction. Think about it. When a traditional hedge fund operates, they take your money. You write them a check, and they manage your funds. Because they are handling client money, the government steps in. They say you need licenses, you need audits, you need extreme compliance protocols to ensure you aren't running a Ponzi scheme with grandma's pension.
Which makes total sense. You are holding fiduciary responsibility.
Right. But prop firms, technically, they don't hold client money for trading. The valuation fee you pay is legally classified as a payment for an educational service or a software licensing fee for the simulated challenge environment. When you get funded, you are trading the firm's own capital. You aren't giving them money to invest. They are giving you access to their money.
So because they're technically trading their own money, the SEC looks at it and says, well, it's your money. Do what you want.
Basically, yes. They fall outside the traditional regulatory framework designed to protect investors because technically, legally speaking, the traders aren't investors. They are independent contractors utilizing the firm's proprietary software.
That is exactly what I mean. It's a loophole. It is a deliberate restructuring of the business model to sidestep oversight. And you can't tell me that doesn't inherently make the whole industry shady.
I disagree. I get defensive about this because ambiguity in the law does not automatically mean a business is a scam. It just means the laws are outdated. The internet moves faster than the SEC. Just because online prop trading doesn't fit neatly into a regulatory box drafted in the 1930s doesn't mean the core concept of identifying and funding remote talent is fraudulent.
But the lack of oversight is exactly what allows the churn and burn firms to exist. If there was a regulatory body auditing these firms, they would look at a firm with a 99% failure rate and hidden slippage rules and shut them down tomorrow. The gray area provides the cover for the scams.
Look, I am not disagreeing that regulation needs to catch up. It absolutely does. And frankly, the legitimate firms want regulation because it would wipe out the scammers that are giving the whole industry a bad name. But until that happens, the burden of proof is on the trader. You, the listener, have to exercise extreme due diligence.
So what does that look like? If we strip away the marketing, the Lambos, the gray area, what is the gold standard? What are the actual green flags according to the research?
Okay, based on the sources, if you want to find a legitimate challenge, here are the parameters you look for. First, realistic profit targets. You're looking for a challenge that requires you to make 8 to 12% over a 30 to 60-day period. That is difficult, but it is actually achievable for a skilled trader.
Not 50% in a week.
Exactly. Second, fair maximum drawdowns. A 5 to 10% max drawdown gives you enough breathing room to take normal market fluctuations without getting automatically terminated by a trailing watermark.
And the company history. The research mentioned a minimum time frame.
2+ years. Do not touch a prop firm that hasn't been in operation for at least 2 years. In this industry, scams blow up and disappear quickly when people realize they aren't paying out. If a firm has survived multiple market cycles over 2 years, they are likely doing something right.
And what about the payouts? Because that is the only thing that actually matters at the end of the day.
Verifiable payouts. This is the ultimate green flag. Established firms proudly showcase their successful traders. They have active, unmoderated communities like Discord or Reddit, where real funded traders can show their payout certificates, show their bank wires, and confirm, yes, I hit the target, I requested a withdrawal, and the money hit my account. If a firm cannot provide massive, independently verifiable proofs that they actually pay their winners, it's a scam.
Okay, so trying to pull all this together, it is messy. It is really messy. There is no clean black and white answer here.
No, there isn't. We can't just wrap this up with a neat little bow. The industry is a spectrum.
Right. On one hand, you have outright predatory operations. Firms that are actively designing their systems to harvest evaluation fees by ensuring a 99% failure rate. They are basically unregulated casinos posing as financial institutions.
And on the other hand, you have legitimate businesses that have democratized access to trading capital. They provide a service, they have sustainable revenue through splits and volume, and they actually pay the people who pass the test.
But the craziest takeaway for me from all of this data is that insanely low success rate, 4 to 8%. Even when the firm is completely legitimate, even when the rules are fair and transparent, over 90% of people are still going to fail.
Because profitable trading is incredibly brutally hard. That is the truth no one wants to put on a billboard. Regardless of the firm's legitimacy, managing risk, controlling your psychology, and extracting consistent profit from the market is a skill very few people actually possess.
Which is why people should really, really think before handing over $1,000 to take a test. They are statistically almost guaranteed to fail. If the firm hasn't been around for 2 years and you can't find ironclad proof of payouts, just run away.
Yeah. And honestly, the failure doesn't even stop at the evaluation phase. Getting funded is only half the battle. Keeping the account is a whole different nightmare. In fact, that is exactly what we are going to dive into on the next deep dive. We are going to break down the psychology of why traders actually blow their funded accounts after they pass the test.
Because passing the test doesn't fix the underlying psychological flaws. I'm sure that will be just as uncomfortable of a conversation.
Oh, it will be. But until then, I think we're done here. We just have to leave there.
See you then?
Wait, before we actually stop recording, think about that casino analogy one more time. The house edge in roulette is what, 5%? The house edge in a prop firm evaluation is 95%. Just let that math sit with you before you click Buy Challenge. Okay, now we're done.